Have you ever wondered how some people grow their money faster while others work their entire lives and still feel stuck? The truth is, they aren't smarter, luckier, or born rich. They simply understand one thing most people ignore: how the stock market actually works. And today, in the simplest way possible, I'm going to explain exactly what beginners need to know before investing a single dollar. Let's break it down. Most beginners imagine the stock market as a complicated place with charts, graphs, and people yelling on Wall Street. But in reality, the stock market is just a marketplace, like Amazon. But instead of buying products, you buy ownership in companies. That's all a stock is, a tiny piece of a business. If the business grows, the value of your piece grows. If the business struggles, the value drops. Simple. Now, here's something beginners often get wrong. They think investing is about predicting the future or timing the market. But the real key is understanding why companies grow. Companies grow when they make more money, create better products, expand into new markets, or increase their customer base. And when businesses grow, stock prices follow. This is why long-term investors make money. You're investing in decades of growth, not tomorrow's headlines. So now the big question: how do beginners actually start? The safest, simplest starting point is something called index funds. Index funds are baskets of many companies all in one place, like buying the entire S&P 500. You're not betting on one company, you're spreading your money across hundreds of strong businesses. Lower risk, better long-term returns. Most Americans who retire comfortably use 401k, Roth IRA, index funds, and automated monthly investing. Not stock picking, not day trading, not gambling on hype. But what about risk? Here's the truth. The biggest risk is not investing at all. Yes, the market goes up and down. That's normal. But historically, the U.S. stock market has always trended upward over long periods. Crashes happen, but recoveries always follow. The people who lose money are usually the ones who panic and sell. The people who build wealth are the ones who stay consistent and patient. That brings us to one of the most powerful concepts in investing: compound growth. Compound growth is when your money earns money, and then that money earns more money. It snowballs. If you start early, even small amounts grow into something big. If you start late, you have to invest a lot more to catch up. This is why financial experts say time in the market beats timing the market. So here's what every beginner should do starting today. Open a 401k or Roth IRA. Invest automatically every month. Focus on index funds. Ignore hype and short-term noise. Stay consistent long-term. You don't need to be rich to start. You need to start to become rich. And remember, the stock market isn't about becoming a millionaire overnight. It's about financial freedom. It's about giving your future self more options, more security, and more peace. So if you're ready to build wealth the smart way, start small, stay consistent, and let time do the heavy lifting. This is Finance Builder, simplifying the financial world so you can build your future with confidence.